Good afternoon, ladies and gentlemen. Thank you for joining the JKH Investor Relations Webinar for the first quarter of 2024-25. My name is Gihan Kure. I am the Deputy Chairperson and Group Finance Director. I am joined by our Chairperson CEO, Krishant Balendra, and we will be conducting today's webinar. The format for today's webinar, as usual, will be where Krishant will initially take us through an overview of the macroeconomic highlights, as well as some of the key developments and projects. And then I will take you through a presentation on the key financial highlights of the group. And thereafter, we will open up for a Q&A session. If you have any questions, please enter it in the Q&A tab at the bottom of your screens. With that, I'd like to hand over proceedings to Krishant. Thank you.
Good afternoon, everyone. Thank you for joining our webinar. I will start with a brief overview of the macro. The momentum continues to be quite positive. We have continued to see low inflation rates at low single digits. Interest rates continue to be low compared to the levels they were a year back, with the one-year bill at about 10%. And the currency also continues to be fairly stable. During the quarter under review here, it depreciated about 6 rupees, but it's still in a much stronger position than where it was 6 to 9 months back. And the volatility is minimal. The program with the IMF continues well. The latest tranche was disbursed during the quarter under review, and the government has also announced that they have in principle agreement on the debt restructuring with the official creditors and with the main discussions are continuing to finalize the agreements. Electricity tariffs were reduced. The announcement was made in June, but the reduction came into effect from mid-July. There was a significant reduction of 10 to 20% depending on the industry group, but it's a substantial reduction for our group, which we will see from the current quarter. As I said, from about mid-July, we will have the benefit of that reduction. A presidential election was declared. It will be held on 21st September. As we have been saying, the main parties are all broadly committed to the current economic path with the IMF program. So we are not concerned of any economic volatility or uncertainty beyond the elections. Elections, as I said, are now less than 2 months away. On some of the key drivers for our business, consumption, for our businesses, consumption saw a good quarter, good growth. Volumes in both the Elephant House soft drinks business, beverages business, as well as the frozen confectionery business saw a very healthy growth over the same quarter the previous year, and continuing good momentum that we had seen in the March quarter as well. Tourism also continued to recover in the main winter season ending around mid-April. We saw numbers from December to April of about 85% of the peak of 2018. In May and June, that reduced to about 80% of the 2018 numbers. But looking at the numbers so far in July, Naturi's number should again be around 85% of the peak. And looking into the next few months, the next peak period in particular, bookings are very encouraging, and we think the recovery will be even better than 85% of the peak. And what is encouraging is that you're also seeing greater flight frequency from some of the major airlines. On our big projects, the West Container Terminal is on schedule Operations will commence early calendar year 2025, and volumes will continue to ramp up over the course of the year with full completion and full capacity of both phases expected to be operational around mid 2026. But we are very excited that the project will start operations in early calendar year 2025. On Cinnamon Life, with the announcement of the agreement with Melco and the rebranding of the complex, it's actually a Cinnamon City of Dreams Sri Lanka, previously known as Cinnamon Life. And the Melco team has started the fit-out work. There is a team now on the ground, and we are looking at a period of about 1 year for the fit-out and operations of the casino to commence. The mall is also expected to commence around then, about a year from now, with the Nua Hotel, which will be operated by Melco, possibly commencing operations a couple of months before we open the operations of the casino and the mall. The Cinnamon Life Hotel within City of Dreams Sri Lanka, which is the main hotel in the property with 687 rooms, and the F&B and the ballroom spaces will begin operations in October this year. So that's just a couple of months from now. We also announced, as you know, a rights issue of 1 for 10 at 160 rupees a share, to be followed by a stock split of 10 for 1. We can go into the details of that as well during our presentation and during the Q&A. So I will hand over to Gihan to go through the quarter under review.
Thank you, Krishan. So we go through the performance for the quarter and some of the key financial highlights. I think Krishan covered some of the operational highlights. In terms of EBITDA for the quarter ended 30th June, the group EBITDA was at around 7.7 billion, which on a reported basis is a decline of around 13% compared to last year. But having said that, in the last year we had a deferred tax credit that was included in that number of 784 million in SAGT, our ports business, as well as then we had the pre-opening costs, which has now ramped up further. So from what we saw last year at around 260 million for the quarter, which has now increased to 775 million or so for this quarter. So as Krishan said, the hotel opening is just a few months away. So naturally the staffing costs, the ramp up, the pre-launch expenses, all these are now sort of coming in. But of course, once we do open, we'll start having the benefit of the operational cash flows as well. So as a result of that, we've seen an increase in the cost by about 500 million compared to last year, and the deferred tax credit that I mentioned. So if you adjust for those two items, then you're looking at a EBITDA of around 8.5 billion versus around 8.35 billion last year, which is a growth of around 2% on an adjusted basis. If you look at the quarterly EBITDA movement and look at the composition of some of the earnings that's coming from the different businesses, we've seen a strong performance from our consumer business, our retail business and financial services. And I'll explain to you what's happened in transportation and leisure. So we've seen a negative impact or decline from where we were last year, the reasons of which I'll explain and go through in the next couple of slides. In terms of finance costs, as we said before, the finance costs of the group have sort of started to come down. As you see at the bottom of your screen, the weekly prime lending rates have come off quite materially, and the rupee debt component of the group was also benefited from that. There are a few other things going on in terms of the loan translation at Waterfront Properties. That's the project company for the City of Dreams project. And because we've seen a depreciation of the rupee quarter to quarter, there is an exchange loss that has come in. So we've adjusted that just to show the more normalized finance cost of the group, which is at around 4 billion compared to about 5.3 billion last year. In terms of the PBT of the group, it's a similar impact that's translating from EBITDA as well. But apart from that, as I mentioned, we have the Forex loss on the Cinnamon Life, the loan. So if you adjust for that and then look at the PBT on a more normalized basis, then we've seen a growth in Q1 of our PBT. In terms of some of our other key balance sheet indicators, we've seen overall group debt has gone up to 230 billion from around 214 billion. But if you recall, last quarter we mentioned that the group debt did benefit from an appreciation of the rupee quarter over quarter. And this quarter we've seen a slight decline or depreciation of the rupee, which also has contributed to that increase. But overall, we've seen the net debt increasing in line with that depreciation of the rupee as well. In terms of some of our key ESG initiatives or the headline numbers, overall carbon footprint and water withdrawal per million rupees of revenue did decrease. And we were more efficient in terms of our water usage, in terms of water withdrawal, driven by some of the initiatives that we've done in our leisure and consumer foods business in particular. We have a lot of other ESG initiatives which we have reported also in the chairperson's message in terms of our foundation. So I won't go through those in this presentation. In terms of the ports, Krishan already spoke of the progress on the West Container Terminal. As you can see the image on the screen, a lot of that work has now been done. And whilst it may not be as clear, what you can see here is the backup yard space that is getting developed and the quay wall and the construction there. So this image is a little older. So if you look at it right now, there's a lot more progress that has been made, and we will be commencing operations in the first quarter of the calendar year 2025 with the phase 1 of the development. In terms of the transportation performance, if you look at SAGT, we saw a strong growth in volumes driven mainly by transshipment volumes. So overall volumes from around 450,000 TEU grew to around 515,000 TEU. The domestic to transshipment mix has not changed. It's been by and large the same, but of course on a higher absolute volume, that proportion meant that we had more domestic volume as well. As the economy has started to sort of show signs of the recovery, we've seen domestic volumes also increasing. So if you look at the numbers here, as I mentioned before, the profitability at SAGT is impacted on a comparative basis because of the tax credit that was there last year, which is what you see in this table. But if you adjust for that, SAGT saw growth in its profitability. Where we did see an impact is that in our bunkering business at LMS, despite a growth in volume because of regional and domestic competitive activities, we did see margins decline with global oil prices also being a little volatile during the quarter. And as a result of that, of last year's base, we did see a decline in the profitability of LMS. But had you adjusted for the main impact is, like I said, the deferred tax credit that was there at SAGT in the last year. In our consumer foods business, we saw strong growth in volumes, particularly in the ice creams business. So the ice cream volumes grew 27% in the last quarter, and beverages grew at 8%. So strong growth in both businesses. We've continued to see that momentum that we saw from Q4 running through to Q1 as well. Overall profitability in the business grew very significantly, essentially doubling the EBITDA that we did in the last year, Q1 of last year. Margins also against last year has increased very significantly from 9% to 16%. Now, if you look at it on a quarter-to-quarter basis from Q4 to Q1, there are elements of seasonality which has sort of impacted overall profitability and margins. But as I said, it's because of that seasonality that you see that skew. Q1 last year was a fairly normalized quarter. So the growth is sort of genuine underlying growth that we have seen. If you look at the margins from 22% to 16%, we've seen a slight decline, but that also is due to the fact that it's a seasonal quarter and the volumes in absolute terms are typically higher in that quarter, which you can see if you look at the graph on the left. You'll see that that volume, it's not a decline on a run rate basis, it's really the fact of the seasonality, and obviously on the slightly lower volume, you lose that operating leverage. That's one aspect. And the other aspect is we did have higher proportional expenses in this quarter. We launched some new commercials as well. So there's a little bit of front loading of some of our A&P expenses that has also come in. The other aspect that shows in terms of blended margins, but that's just a margin. In absolute terms, we've seen our ice creams business show strong profit growth, but we saw higher contribution coming from our bulk versus our impulse. So as a result of having higher bulk sales, the blended margins comes down, but overall, you still see that overall volumes grew 28%, and that was net obviously positive to the P&L. Moving on to our retail business, we saw same-store sales growth at 12%, driven again mainly by footfall. So as we've seen over the last many quarters, we've seen double-digit growth in footfall, and that trend has continued. Where things have changed for the better is that what we saw as declines in ABV has now sort of, it's a very marginal growth, but it's not a decline that results in a drag down on the overall same-store sales. So because that is flat, essentially the entirety of the footfall growth has translated to same-store sales growth. In terms of EBITDA, again, strong growth against last year, the same quarter, and our EBITDA margins have grown as well from 6.3% to 6.7%. Here again, if you look at it on a quarter-to-quarter basis, the margins have declined and the profitability is slightly lower. But here again, there is a certain seasonal impact, as well as in Q4, we do have some promotional income and rebates, which typically gets recognized and finalized in the fourth quarter, just before the close of the financial year. So as a result of that, you see that sort of spike in the margins, though overall, based on the trends we are seeing, based on Krishan spoke of the electricity tariff reductions that we've seen in March, as well as another round of reductions, which was around 20% in July, will also contribute positively towards margins as well as profit growth as we get into the next couple of quarters. In terms of our BYD, the NEV vehicles, we are scheduled to open the showroom in August. Coming back to just retail in terms of the electricity cost and margins, as we've shown in the previous quarter, the impact of, as you can see, the percentage of electricity to revenue has sort of started to come down as we've seen the cost come up, as well as revenue growth continuously coming in. Looking at a decomposition of our same-store sales, as I said, we've seen strong footfall growth and ABV was flat. In the last quarter, we saw inflation being coming in at about 2%, and overall ABV is flat. So the effect of the number of units that are being bought in a basket, which we did see a decline in the last couple of quarters, it's still a slight decline, but that pace of decline or trend is now also getting better, which is why you don't see a similar sort of drag down effect where the positive of inflation is only marginally offset by the negative number of units or weight of purchase, as we call it. In terms of tourism and arrivals into Sri Lanka, continue to see the sort of growth. The first quarter typically is a off-peak quarter, and even July tends to be that, but we are starting to see the growth in overall arrivals. We crossed the 1 million mark in June, and now we expect to see this trend continuing. The momentum for the winter season looks positive in terms of forward bookings. We are still not at the pre-pandemic levels of occupancy or arrivals rather, and that's something that the industry is focusing on in terms of trying to push the authorities for more targeted destination management campaign to attract more arrivals into the country, especially focusing on some of those key source markets as well. Looking at the Maldives arrivals numbers has continued to show positive signs where you see growth over the previous year. As we've said before, though, the composition has changed a little bit, particularly in the off-peak season. In the peak season, we didn't see that impact with the segments that go to patronize the guest houses, and the numbers were quite strong, as you will see in the next slides. But in the off-peak season, we see that impact where there is a dilution in the number of room nights that are spent in resort hotels, which has had an impact on our performance. So the overall leisure performance really has been affected mainly by the performance of the Maldivian resorts due to those reasons, and I'll touch on that in the next couple of slides. But just before we move on, if you look at the Sri Lanka story, and looking at how outbound travel has been in markets like China and India, and looking at how this has evolved over the last 20 years or so. We are looking at this up to 2019 because post that there have been obviously the disruptions due to the pandemic. But if you look at it in 2019, India had around 27 million outbound arrivals. And if you look at it, China was there roughly in 2003. So as the Indian economy has shown growth and the per capita incomes of Indians increase in line with what, say, China was maybe 5 years ago, 10 years ago, we could see that sort of explosion of the numbers similar to the trend that we saw with China. And obviously, needless to say, Sri Lanka is very well capitalized to take advantage of that opportunity given our proximity, given the connectivity. So the focus, of course, has to be on increasing air connectivity into Sri Lanka. And of course, as long as demand is there, we are quite confident that airlift capacity will also increase. With now, Krishan spoke earlier of the progress on the debt restructuring and support from the bilateral creditors. So some of the projects that have been stalled, including the airport terminal expansion, something that will then hopefully get completed in the near future. Moving on to the leisure numbers itself, if you look at the Colombo hotels, we saw overall ARRs have grown against last year. Occupancy, of course, it is off-peak quarter, but overall the EBITDA margins have been sort of in line with what we saw last year. Sri Lanka resorts, again, being an off-peak quarter, the EBITDA margins have been more positive than it was last year, though still in the red. But overall, ARRs, as you can see in terms of our strategy, in terms of looking at driving yield, has sort of been positive. The occupancy has been marginally lower. As I indicated earlier, the challenge has been more in the Maldives, where we've seen occupancy has come off somewhat more materially. And whilst the ARRs have remained flat, that reduction of 11 percentage points in occupancy has actually resulted in a decline in the EBITDA margins and overall performance of the Maldivian resorts. So the leisure numbers here, of course, as I mentioned earlier, we have the ramp-up costs of the City of Dreams project coming in as well, which I touched on earlier. So this number that you see on the screen here includes those ramp-up costs, but if we normalize it, it is still below what we did last year because of the Maldivian performance. This is just a quick recap in terms of City of Dreams Sri Lanka. I won't go through the slides. It's something we spoke of extensively before, but just to that we have, as Krishan said, started the fit-out work, where Melco has started the fit-out work rather of the gaming space. and work will now ramp up quite significantly there, and that was subsequent to signing and finalizing the 20-year lease agreement with them. In terms of our property business, at Cinnamon Life, we've seen interest, but some of this has not translated to actual sales or nothing material. So the main components of revenue are obviously from the Cinnamon Life residential sales as well as Trizen. We did see some sales at Trizen, and given that the project is now at completion and now we are in the process of starting or ramping up the handover process. So we will see in this current quarter and the next couple of quarters ahead, the revenue recognition and profit recognition from Trizen materially increasing, and hopefully we'll see more traction on the Cinnamon Life sales as well. In terms of financial services, the numbers that we're showing here for Q4 is actually what we had reported earlier. We've seen good progress though, so the numbers here, something you've already seen, even that time lag in terms of our consolidation cycle. But overall, we are seeing good GWP growth in the insurance business. The bank also is showing very positive results, and the underlying momentum of both businesses is very positive. So just finally, before I conclude the presentation, as Krishan touched on, we announced a rights issue just yesterday. So the details of the rights issue are on the screen. I won't sort of repeat everything here, but essentially it is where we are looking to raise 24 billion rupees through a 1-for-10 rights issue. Subsequent to the completion of the rights issue and the process and the listing of those shares, we have then also announced a subdivision of 10 shares for every 1 share held post completion, as I said, based on the listing of the number of rights. We will be submitting a circular to the shareholders post approval from the stock exchange, and the details of this will be contained within the circular. The exact dates for the EGM and so on will also be covered in that circular. I'll just use this opportunity to elaborate a little bit on the reasons or rationale for us doing this rights issue at this point of time. As we mentioned in the announcement, this is essentially to fund the future commitments into the City of Dreams or the Cinnamon Life project, where we have around another $90 to $100 million of project expenses, funding requirements into the project. Now, in terms of the reasons for this, in terms of doing the rights issue at this point of time, we have the gaming operations, which will now start in June next year. Our expectations, as we've sort of spoken of this over the last couple of years, last year we were hoping that we would have the gaming operations up around operational at this point of time, or maybe around November, December. We did have the regulations coming through. I think you all know the fact that Melco obtained a license, 20-year license, but the development of those regulations and engagement on that and getting it over the line naturally took time and a little longer than we expected. And that in turn naturally did have an impact in terms of us finalizing arrangements with Melco, and obviously for them to have the confidence to commence investing and putting money down to start the fitting out and equipping. So we've just started that part of the work. So essentially the delay in generating those operational cash flows from the gaming operations, as well as to some extent the rest of the hotel operations, which everything will really ramp up and be ready from June next year, though the hotel and the other related facilities will be up and running from October onwards. So there was a timing difference or bridging of that funding that we needed to consider when we did this rights issue. The other aspect was, as we've spoken over the last couple of quarters, we've seen strong interest in the apartment sales, a lot of leads that have generated. As we get to completion and operationalizing of the hotel, we are very confident that with that, as well as the gaming, that apartments will sell. But we haven't seen the cash collections or inflows to the extent that we would have anticipated or liked at this moment of time. And that gap is also something we did consider when we looked at the rights issue. We've also spoken previously about a couple of other transactions we were looking at in terms of restructuring our leisure portfolio, looking at how we could consolidate our assets, and the fact that we needn't hold 80 to 90% of all these assets. And that's something we've been working on. So a lot of work has been done on this. We've been continuously engaging with prospective investors and seen interest, but that interest also has not transpired into a transaction itself. Naturally, whilst the macro has been quite stable and things are looking positive, some of the sort of uncertainties also which have now got cleared progressively, like the external debt restructuring and so on. But we have not been able to conclude some of these transactions, which would have also ensured that there was some cash coming in. The reforms, even the government reforms, have taken a little more time, I think, given the macro, and maybe investors also waiting to have certain clarity on that. So I think this was, if you look at the sort of combined reasons, we felt that this was the time that we should go ahead and raise this money, which would then give a group the ability to manage our balance sheet better and have a little more flexibility in terms of how we look at our investments. I will just pause with that and conclude the presentation. If there's anything further on the performance or the rights issue itself, Krishan and I will be happy to take any questions. Just to remind you that if you have any questions, you can enter it into the Q&A tab at the bottom of your screens. Thank you. So Krishan, maybe just to kick things off, there are a couple of questions on the Reliance operations and whether we started, CCS started the operations with Reliance, as well as, I know we can't disclose the percentage of royalty fees, but maybe if we can just give a flavor of what that commercial arrangement looks like.
So we have started distributing Necto flavored drinks in South India. Still early days, it's only a few months since it was first introduced. But the traction has been fairly encouraging. Too early to get too excited, but they've seen perhaps even better than expected traction. Volumes, of course, are still small. The commercial arrangement is, it's a franchise fee similar to what a bottler would pay a brand all over the world. It's we send the concentrate from Sri Lanka, and there is a payment for the concentrate and a percentage of the sales price. We're very standard for a arrangement like that, and Reliance is responsible for bottling, distribution, and marketing. So we started with Necto, fairly good start, but early days.
Thanks, Krishan. Couple of questions. I think we covered this, but just in the presentation, but just in case someone missed it, there's a question on the Asian hotels, that's essentially Cinnamon Grand, recording a loss for the quarter, and it's in line with expectations, and about market share, and also about the main reason for KHL or John Keells Hotels to report a loss. So with Cinnamon Grand, like we showed in our numbers, we've seen overall the EBITDA margin has been in line or slightly better than last year. We've seen ARRs increasing, and it's a sort of off peak. We don't see that those sort of numbers. So it's in line with what we saw last year. Overall numbers into Sri Lanka and Colombo hasn't been as strong. So in that sense, you could argue that it is below expectations more from that headline numbers coming into Sri Lanka as well as the city. But in terms of our fair share, it's not that we have lost share. We've done well in that sense, but it's more sort of what's the overall numbers coming into the country. In terms of John Keells Hotels, the impact is mainly coming from the Maldivian resorts, like I said, because the Sri Lankan resorts, whilst it is a off-peak season, and unlike city hotels, the resorts have a proper off-peak season. And we did see numbers coming off as a result of that off-peak, but we've done better than last year. But the main reason is, like I said, the decline in the Maldivian resorts, the performance there. There's a question in terms of the pre-opening costs of 776 million that we referred to in that slide. That is mainly the, all the staffing costs, but as well as some of the other groundwork in terms of the marketing costs, the PR costs, as we get into launching this in less than 3 months' time, or really 2 months' time. So it's those costs as well as, of course, the staffing costs, because we are opening a 687 room hotel. All the ballrooms, everything will be open. Some of the restaurants will be open maybe a month and two staggered, just purely more from a marketing point of view in terms of a launch strategy. But we have all the people in place. So there's over 1,200 people that will be in place to essentially operationalize all these different venues and the 687 rooms that we have. In terms of number of people overall in the complex as well as the hotel, it will be at a very efficient level. It's a purpose-built hotel. So compared with even our current 2 city hotels, the number of staff in terms of staff to room ratio will be more efficient. There's a question, Krishan, on bunkering volumes. So compared to Q4 24, bunkering volumes, did they grow? So as we said in the presentation, we saw a growth of around 12% in volumes. But just any color we can give in terms of the competitive environment and the margins, because it was a combination of competition as well as oil price volatility.
Yeah, it was the oil price volatility did have an impact on the profitability, and the competition also was more intense. We've seen now Sinopec supplying bunker fuel from Hambantota, which makes it easier to access fuel supply. Previously, all the players were sourcing it directly from overseas, and LMS did as well. So there is increased competition in the market, which had an impact on margins. But we expect that this will settle going forward. And in fact, we are already seeing some improvement in the operating environment in terms of margins.
There's a question in terms of the percentage cost saving from electricity tariffs. As we said, in July, we saw on average, because it depends on the tariff band that you sit within, or the tariff category rather, but a 20% reduction in electricity tariffs, which will benefit our consumer, our retail and leisure businesses. I think we've given color in terms of what that means to our supermarkets business. And we started seeing that sort of the margin benefit or the percentage of electricity as a percentage of revenue. And we saw that number reducing, and that reduction was based on the tariff reduction we saw in March, and the July number will give a further reduction. So I think rather than giving direct guidance, I think that may be one way you could look at margins. Krishan, just a question of the basis for the stock split. The comment is that it says JKH doesn't need to trade at a lower rupee level, but what the rationale is for the subdivision.
Yeah, I mean, it was that by having a lower face value, we could get better participation. We've had a few comments from the market. So it was more to increase the number of shares, reduce the face value and have more liquidity so that we could increase the smaller investor participation.
On leisure, Krishan, in the Maldives, given the economic challenges faced by the Maldivian government, any risks and opportunities that we see?
Given
the Maldivian, any risks and opportunities we see
because of the
given the uncertainty and the political
I mean, I think the impact is already being felt because the Indian the numbers are lower because of the geopolitical tensions we've seen. Initially, it fell very sharply, and we are seeing a gradual recovery, but it's still not back to normal. And that is what has had partly impacted the June quarter as well. Going forward, unless something new happens, we can't see a negative impact in the Maldives. And so numbers from India should continue to grow. Actually, it's encouraging to see that numbers from China into the Maldives have grown quite strongly. So at the moment, we can't see any risks beyond the impacts that we have already seen.
There are a couple of questions relating to City of Dreams. I'll try and cover them in one go. There's a question in terms of giving more color on the interest for the Cinnamon Life apartments. Like I said, we've seen a good number of leads coming through, a lot of interest, but the conversion is where it has been a little slow, though we have had 1 or 2 sales taking place. We expect this traction to increase. I mean, interest rates are very low, and expectations are that interest rates could continue to remain low. Maybe once the elections, once we cross that, I think we could expect to see traction, given that we will be then operational as well. So today, though we have the apartment complex and the 2 residential towers developed, the benefit of the integrated nature of the complex doesn't fully come through. Whereas once we start the hotel operations, the F&B operations, as well as then, of course, when we have the full retail aspects in June next year, then we'll have the full benefit. So we expect to see traction to sort of gather momentum, but I think the sales will start increasing from next year onwards, and we're very confident of that. Staying with City of Dreams, how much are the occupancy levels, or how much of the spaces have been leased out? So as we said before, we've been a little slow intentionally in terms of signing up the leases till we had the clarity as well as the ability to announce the Melco partnership. So now that that has been announced, we are going all out in terms of finalizing the conversations that we had already begun. But naturally earlier we couldn't disclose any of the details of the gaming related partnership or the party that we were tying up with. So I think in terms of actual lease ups, we haven't concluded anything, because actually we wanted to ensure that we have that ability to structure the totality of the gaming, the spaces in line with the gaming strategy as well, getting input from the operator. We have signed up or just about to close up with the cinema operator, which is a large anchor tenant, and lots of interest on the leasing. So we are very confident that these will get closed out in the next maybe 6 months or so, so that when we are ready to start the gaming operations, that the mall will also be able to commence operations at that point of time. There's a question on whether we've drawn down on the $225 million syndicate loan at Cinnamon Life. And yes, this was essentially where we refinanced the previous loan, and we had a $225 million from December 2021, and that loan still is there. As we said at the time, the repayment of that loan was very much back-ended. So the loan has now come down marginally to around 220 million because of that sculpted structuring that we have. There's a question on the expenses attributable to City of Dreams, and whether we expect these to remain elevated until the opening of the project. So a lot of this is the staff costs as we ramp up. Though, like I said, there will be certain marketing and launch related expenses as well. But given the size and scale of the project, these expenses will sort of continue, while some of the marketing and launch related things can come off. I think the main aspect of it, of course, is that we will start generating cash. And as we start ramping up the operations, then these costs will be absorbed quite easily. Krishan, there's a question about the impact of the Vizhinjam port on the Colombo port in WCT, SAGT, and the overall port of Colombo.
Yeah, we don't expect it to be. We've actually discussed this with our ports business. We don't expect it to be material at all. To begin with, Vizhinjam will have a capacity of 1 million, and there is no timeline for the additional capacity. The maximum capacity there can be only about 4 million, compared to now Colombo's capacity today is about 7.5 to 8 million, and West Terminal will add 3.5 million, so that goes to over 11 million, and then East Terminal potentially can add another 3 million. So compared to the scale of Colombo, Vizhinjam adds 1 million in what they have built, and it can potentially go up to about 4 million. So we don't expect it to be have a serious impact on Colombo volumes.
There's a question, Krishan, on lower Indian arrivals negatively affecting occupancy in Maldives in the off-peak season. Any comments on that?
Yes, it has. As I mentioned earlier, with some of the geopolitical developments with the new government in the Maldives, we saw a sharp drop in arrivals from India. And India, since COVID, grew very fast to be the #1 market into the Maldives. So there is a significant impact from Indian numbers falling. Although we don't, in our 4 properties, see a material Indian occupancy, because some of the other properties are seeing a material impact, there are more rooms available in the market, which has impacted us as well. But we are seeing that from the trough, just after the elections, we are seeing a gradual improvement in arrivals from India.
There are 2 questions on BYD, Krishan, whether they are the sole authorized distributor of BYD, any potential for other parties to import BYD into the country, as well as the long-term plans for BYD beyond maybe just being a dealer.
Yeah, for BYD passenger vehicles, we are the only authorized distributor. We do not have anything planned at this stage beyond being the distributor. But of course, depending on volume and developments in the region, more could happen, but there is nothing specific planned at the moment.
Thanks. A couple of questions, bear with me, I'll try to sort of ensure I try and cover all of these in sort of one go. There's a question on the proceeds from the rights issue go towards retiring debt. As we said before, the purpose of the rights issue is really to fund the future infusions into the Cinnamon Life project for the funding requirements that I already mentioned previously. So it's not directly to reduce our debt levels, but of course, as an offshoot, it means that what we would have funded anyway in terms of drawing down on our existing facilities, that won't happen. But like I said, it's not to directly reduce our debt levels. There was also a question in relation to this in terms of what if the rights issue doesn't raise the funds that we are looking to raise, and what our alternate plans would be. As we've said before, I mean, the group can fund this balance. It is possible. It's just that then we need to draw down on more debt. Our total debt levels, whilst comfortable at a group level, if you look at our holdco debt, then we will have to draw down on another roughly 30 billion rupees more of facilities, which we have and we can manage, but it's just that it takes the debt levels up somewhat more significantly. And of course, whilst the macroeconomic outlook is stable and looks positive, if there are any sort of if there is any volatility, then we'd rather not have those levels of debt and be a little more comfortable. So it was more from that perspective that we looked at it. There was also a question on relating to the rights issue, whether this will dilute the stakes of CCS and JK PLC in the waterfront project. Actually, that has nothing to do really with the rights issue, because the way we've been looking at this is where John Keels has been funding whatever the equity requirements or funding requirements of the waterfront project. And whenever that infusion has happened, then there is a dilution. So the rights issue itself does not come into play necessarily, because irrespective of the way we fund John Keels, when John Keels is funding the project company, that dilution would take place in any case. There's also a question on the IFC loan and when it starts, the capital repayments will commence. So as we said, we had this loan from June 2020 onwards with 4 years of grace. So the first capital repayment will start in December this year, and then it's a 6-monthly repayment cycle. There's a question on the fixed rental for the gaming space. As we've said before, we are not disclosing the breakup or split between fixed and variable rent. But the guidance we've given is that this would be around 50%, 50 to 55% of the EBITDA of the project. There was also a question in terms of GGR projections. As we've said before, we are unable to give guidance on what the gaming projections would be. And of course, it's really Melco who will be running the gaming operations. But in the last presentation, I think, and which will be available still on our website, we did speak of the performance of other IRs in the region, how they have done, how the gaming market itself has normalized. And in that context, then one can sort of make their own assessment of what the potential GGR could be. So I'll just leave it at that for the moment. Krishan, just in terms of expectation for occupancies, I know again we can't give guidance, but at Cinema and Life over the next 2 years, what will that be? Obviously, with gaming,
we don't give a guidance normally, so I don't want to give any guidance on what occupancy could be. Obviously, we've had the ITC hotel opening, then Shangri-La just prior to COVID, a number of other smaller hotels. And then the Cinema and Life Hotel and the City of Dreams, all those rooms get added from October onwards. I think what I can say is that if you look at integrated resorts in the region, whether it is in Singapore, Manila, or Macau, they all operate at very high occupancies. Generally, it's well over 80%. So that's one way of looking at it. But Colombo is a new market for an integrated resort. So it doesn't mean we'll follow the same patterns that have been seen in Manila and Singapore and so on. But that's one way of perhaps trying to estimate what we could do. It won't happen overnight. And as I said, Colombo is a new market for an IR. So it's a bit difficult to predict with too much certainty.
Thanks. Anything just in terms of the current beverage and FC demand outlook?
I think we've been very encouraged by the recovery that we have seen in volumes in the last 6 to 9 months. And while ice cream volumes are at a peak and continue to grow, this we were expecting in our long-term plans, because frozen confectionery consumption in Sri Lanka is still quite low compared to other regional countries. And we also think that there could be a shift from other types of confectionery to ice cream or frozen confectionery. Our beverage volumes have picked up, but they're still not back at the peaks. We had, of course, extreme peaks in 2015, 2016, when there was a boom in consumption. We are still well below those peaks. But again, in terms of CSD consumption compared to regional countries, Sri Lanka's consumption is quite low. So we are positive on the outlook of both frozen confectionery and beverage volume growth.
There's a question on the short-term borrowings, the increase quarter on quarter, which has increased quite significantly. The reason for this is, as you all know, we have the convertible debenture that's outstanding. Part of it got converted. So there is around 12 billion rupees of that debenture that is still there. And given the timing, then that exercise is due, the latest date for exercise is August next year. It falls within the criteria from an accounting perspective that it has to be treated in the current liabilities. So it's just a shifting of that accounting treatment of shifting that current liabilities. That is the increase that you see. And of course, like we've said before, we are confident that these debentures will get converted as opposed to having to repay. But this is more the accounting treatment of that. In terms of our interest cost itself being elevated in the coming quarters, I think given the higher short-term borrowings, like I said, so this, whilst this is reflected in short-term borrowings, as we've said before, it's more notional interest cost that's there on the debenture with HWIC, and the actual cash interest cost is very low at a 3% coupon. But yes, with some of the funding that we have, depending on how things go, and we spoke on the rights issue and of course the impact it has on our future then debt levels, then we should not see an increase in interest costs in the holdco and therefore as a group. There's a question on the price adjustments for frozen confectionery and beverages, and whether the recent reduction in electricity tariffs, whether we would be looking to make adjustments. Whilst it is somewhat material, it is not the key driver of our cost structures in terms of frozen confectionery or beverages businesses, and it's more the raw material prices and so on. And we've been very clear that we want to ensure that our margins do recover to a particular point. And of course, if we see input costs coming down further, then it's something we could revisit. But at this point of time, we don't envisage a cost reduction purely on the electricity tariffs, because there are other sort of things that would even that out. In terms of our supermarkets business, there's a question how many outlets we are planning to open in FY25. We were looking at around 8 outlets. So during the financial crisis, we consciously were slower in our expansion, but we are looking to pick this up. As we've said, the underlying long-term growth opportunity for supermarkets is very much there, and we will continue to expand. I think we've spoken of this before, Krishan. There's a question though on the plans for refurbishment of Cinnamon Grand and resorts, any other resorts in the near future.
I think all our resorts refurbishments were completed actually just prior to COVID. And during COVID, we refurbished Hiccup Trans. So in Sri Lanka and the Maldives, the resorts don't require any immediate major refurbishment. In the city, Cinnamon Grand and Lakeside do require refurbishment. However, we will watch the market demand, and as demand group picks up and occupancies pick up, we will look at a phased refurbishment of the properties. But as I said, resorts, nothing is required for some time, and the city will really depend on how occupancy picks up.
There's a question on the management fee for the Nua Hotel, which will be managed by Melco. So as we've said before, that's sort of a very standard hotel management operator fee. We can't disclose the details, but it is very market standard management contract that you would have for a hotel manager. And yes, this management fee will be, of course, with Waterfront Properties as the asset owner, essentially will bear the fee that will come in, and it will be on their P&L. Of course, the revenue and the upside of the operations also will sit with the entity, given that we are only giving it out on management. There's a question on the contribution from private labeling to our retail top line, and whether how many products we carry. I don't have an exact number in terms of the number of SKUs. I think it's around maybe 7% of our total that we look at in terms of private label. So despite the revenue growth, private label has grown from around 5 to 7%, and it's been a conscious strategy of ours to try and continue to drive private label. It naturally has, of course, a margin benefit, but we're also looking at it from the perspective of a wider offering for our customers. And particularly in the last year or two, with the financial crisis and the inflation and the way the economy has been, it's something we believe has been very helpful and appreciated by our customers, and of course, benefiting us also in terms of better margin. I think that brings us to a close in terms of time. I covered all the questions, or most of it. Thank you very much for joining the JKH Investor Webinar. This presentation will be uploaded on our website and will be available for viewing in the next couple of hours. Thank you once again for joining us.
Thank you.